Welcome back, everyone. Today I dove into another 40 pages of the essay of Warren Buffett by Lawrence Cunningham. Today's chapters cleared a bit of technical details for me, and these are the insights I was able to get from it. First was when Warren Buffett talks about asset allocation. He says, first was when Warren Buffett talks about capital allocation. He says that the CEO of a company should be able to allocate the capital in a company without depending on external help. And the second part was when he talks about margin of safety. Margin of safety is Warren Buffett's golden rule. So in simple terms, margin of safety, it is the gap between the price you pay and the value you get. So basically, it's just saying that when you are trying to buy into a company, it is better to buy it when the market price, which is the price on the stock market, is below or near the intrinsic value of the whole asset of the company. So in that situation, you gain more value for the money you pay to acquire the assets of the company. And the third insight I got was when he talked about why he prefers buying preferred stock over common stock. From what I understood from the passage, preferred stocks are like bonds. So investors who buys the preferred stock of a company instead of the common stock are first in line in getting paid the dividends of the company. So the people that buy into preferred stock are paid first before those owning common stocks. And yet, there is a potential for him to miss the upside of the common stock. In that case, he's able to pre-negotiate a price in which he's able to exchange his preferred stock for common stock in the future. Let's say when he buys the preferred stock, the common stock is trading at $50. And after he buys into the company through the preferred stock, the shares now trade above $100 or let's say $200. If he's able to pre-negotiate a price in which he's able to exchange his preferred stock to common stock, let's say at $80, when the stock is at $200, he's able to exchange it for $80 in common stock and still capture the upside with the common stock. So it's a win-win situation for him. And the last point I got from reading today was when he talked about the danger of buying high-yield junk bonds because of their interest rates. And he says that in a situation in which an investment banker tries to sell you a junk bond, then you should tell the investment banker that the only way you buy the junk bond if he forgo his commission for selling it to you, and you only gain a commission if the junk bond pays you. That is a way to test if the investment banker is serious about the junk bond or is just chasing commission. Yeah, and those are the 4 insights I was able to gain from reading 40 more pages today. And the next part is about my trading. On Saturday, I talked about having 3 pairs that I'll be trading this week, which was Audi CHF, Pound JPY, and CHF JPY. I made a change to those 3 pairs on Sunday, which now Audi CHF, Pound CHF, and CHF JPY. As of midnight today, I was able to get an entry on Audi CHF. Although I had 2 entries for CHF, the one was enter immediately after market price or to enter below it at my support zone. So fortunately for me, when the market opened, I had to wait for spread to close. And when spread closed, the market dumped support and I was able to take the position from there, which was actually a better entry for me because I'd been able to take it from the opening price. I would have lost the initial position and had to re-enter again at the support line because that was the 2 entry I had. I was willing to play it both ways. So luckily for me, the second scenario was the only one available to me today. So yeah, I'm on that trade and I've so far been able to calm myself down. I had the urge of entering another position, but I reminded myself of what I told myself I'm going to be doing going forward. My account is not yet big, it's around, as you can see. I only deposited $4 because I wanted to keep it as simple as possible to see if I'm able to trade up. Then yeah, that's how I'm approaching right now. Calm, focus, and taking it one step at a time and seeing how the market goes from here. And the last part, things are found interesting on the internet. And today I saw a tweet that talks about a Nigerian earning 200,000 naira on a monthly basis, and all of a sudden the person feels the need to go and collect a $1 million apartment. I see that, although it was from Nairametrics, which you should be seeing now, the video was trying to make a point on not doing that, which I actually support, because I don't see why you be earning 200k and you want to go for a rent that is above 1 million, because basically you're actually paying like 40 to 45% of your money, of your yearly money to rent, because on a yearly basis the total money you earn will be 2.4 million naira and you're paying 1 million naira for rent, so you're basically having 1.4 million naira left. So my take on that is that I don't think anyone should be paying 40 to 50% of their yearly wages on rent, especially if they are able to reduce it by going for something less cheaper. Try as much as possible to build their financial vault first before trying to live around that means. So yeah, that's all for today. Thank you all for listening. See you all tomorrow. Bye.